Many property owners are installing EV charging stations in their parking facilities, and they're providing, obviously, the electricity that the EV station needs to run. So for the first time, the IRS addressed whether or not that is a good service.
Joining me today is Craig Stern, Managing Director with Forvis Mazars. Craig, thanks so much for joining us today.
My pleasure, Matt. Good to see you.
As we know, a REIT must earn at least 75% of its annual income from real estate sources and at least 95% of its annual gross income for those and other passive sources. Now, I understand that the IRS recently issued a ruling on what happens if a REIT is formed and has no income or assets. Can you explain a little bit about what that ruling says and how it could affect REITs going forward?
It's a very interesting ruling. For the first time, the IRS addressed what happens if a REIT does not have any gross income or gross assets at the end of the year. An unusual situation, which I'll get into the facts of how this came about and how to avoid it. But in this ruling, the taxpayer, a REIT, was formed to acquire a portfolio of real estate property. So they fully expected to have good REIT gross income and gross assets by the end of the year. Unfortunately, various hurdles hit, and they were not able to get the funding that they expected. So at the end of the year, they wound up with no income and no assets. And they went to their accounting firm, and they asked their accounting firm, I have no gross income, I have no gross assets, do I pass the REIT tests? And the accounting firm said, it's not clear, but we think you do. So they went out and filed a REIT return, which is effectively how you make a REIT election. So now they've made an election to be a REIT. Shortly thereafter, the shareholders of the REIT hired a different accounting firm who looked at it and said, we don't think that you've met the tests. So we want you to go to the IRS and ask them for permission to revoke your REIT election and just be treated as a C corporation for the year. So basically they asked to not be a REIT, but sometimes you get what you need even if it's not what you asked for. So in this case, the IRS looked at the legislative history behind the 75% gross income test, the 95% gross income test, the 75% gross asset test, and said, we believe that Congress was looking at whether the income was of a nature that was passive. They weren't really looking at the amount of the income. And therefore, the IRS concluded that a zero income and zero asset, because you have no bad income and because you have no bad asset by definition, the government ruled that you are, in fact, a REIT. So they filed a REIT election, and they actually were a REIT. I mean, the importance of this ruling is one, it's the first time the government ever issued this kind of ruling. So if your client finds yourself, or you as a REIT find yourself in this position, you can feel some comfort that the IRS's well-reasoned decision ruling based on legislative history gives you a firm support for that position. It also tells you that if you let your advisors know in advance that this is happening, they will counsel you to go out and get an asset that produces good REIT income. A lot of people recommend that the REIT go out and buy preferred stock of another REIT that's going to pay a dividend during the year so that you have good gross assets and good gross incomes. Other people say you can rely on the temporary investment of new capital, which basically says if you get money during the year, you can buy any stock, you can buy any debt instrument, and it's good, even though what you invested in is not a REIT. So those are the two ways to handle that situation. So if you know about it up front, you proactively handle it. And if you don't know about it up front, you have this ruling to rely on.
And can you explain the recent IRS ruling regarding whether REIT properties can have EV charging facilities and what the tax consequences involved with that might be?
Many property owners are installing EV charging stations in their parking facilities, and they're providing, obviously, the electricity that the EV station needs to run. So for the first time, the IRS addressed whether or not that is a good service. And the ruling is sort of interesting in that they looked at and they said there are a number of conditions that the EV station and the fee owner has to have for it to be a good service. They looked, and a lot of those conditions were based on Revenue Ruling 2004-24, which is a parking ruling, which tells you whether or not a parking facility is a good service. So they sort of took that ruling and they applied it to an EV station. Just to highlight a few of those items, they said that the EV station must be appropriate to the size of the people who are intending to use it, the tenants, their guests, their customers, that the EV station is a customary service in that same geographic area for that type of property. And the third thing is that while there may be some public service, public use, that it has to be de minimis. So they ruled that it's a good service, but under conditions. So going forward, if you want to rely on that ruling, you will have to try to meet those conditions to feel comfortable that you're within that ruling.
And finally, I understand that the IRS recently released two very similar private letter rulings regarding use of airport terminal space and deemed interest from prepaid rent loans. What can you tell us about these rulings, and do you view them as possibly significant for REITs?
Yeah, I think these rulings are very significant. One, it sort of illustrates that REITs have expanded beyond office buildings and apartment buildings and shopping centers. This was a REIT that entered into a long-term lease with a public authority to build and expand airline terminals. So something that is part of the infrastructure development for this country. And so the REIT entered into this long-term lease with the public authority, but then turned around and subleased it to all the airlines that uses the public, uses the facility. They structured the rent in a very interesting way. The rent was it was a fixed rent based on the expectation of how people were going to use all the gates and the common areas within the terminal. And they created a formula that said, we're going to, based on your historic record and what we know and your projections, we're going to charge you rent of X amount based on the expectation of number of flights, number of passengers. And therefore, even though each gate, which is where the passengers wind up, that's not significant. You're not renting a particular gate. You're not renting a particular space. You're renting the concept of there are going to be spaces made available to you based on this expectation, and you're going to pay us rent based on that. And even if you don't use that space, you still have to pay this fixed rent. So in that case, it's very similar to cold storage ruling, which is sort of based on volume and not a designated space, or digital signage, which is also based sort of on usage and space made available and not based on a particular location within that digital sign. So that's one interesting feature of the ruling. The other is the whole concept of 467 loans. So in this case, the 467 loan, which is basically when a REIT makes a prepayment, or anybody makes a prepayment, in this case, a REIT makes a prepayment of its rent. So in this case, the REIT prepaid its rent by actually constructing, the cost of constructing the terminals and the gates and all the other expenses was treated as prepaid rent under a Section 467 agreement. And the question for the first time is, what is that asset? What is that income for gross income and gross asset tests? So in this case, the REIT made a representation that the leasehold interest was a good real estate asset, which makes sense. It's a leasehold interest. They didn't talk about the 467 loan at all. So they never asked the IRS to rule on whether or not a 467 loan is a good asset. So you could say that's either an open question, or because GAAP treatment of a prepaid loan treats it as something called a right of use, which is basically a real property interest, that maybe the government agreed with the REIT that their representation was correct, that a prepaid loan for GAAP purposes is not a loan. It's a real estate asset. But for tax purposes, under 467, a prepaid rent creates a loan. And a loan is normally treated as a security. So in this case, you had a discontinuity between GAAP, which says it's real estate, and tax, which statutorily says it's a loan, it's a security, and has totally different tests. So the government never went into that issue of whether or not it should be treated as a security. So that's one part of the ruling, is what they didn't address. The other part is the nature of the income. The government has authority under Section 856 C5J to treat things that are not specifically mentioned in the code as being good income for 95% test and 75% test as being good income for those two tests. And they use that authority quite often, especially in these private letter rulings. In this case, they decided only to treat it as good 95% income and not good 75% income, which is a result that I think they could have reached a different result. They could have reached the result that this is a loan created through a lease. The lease is obviously real estate. The payments of interest is in connection with entering that lease and the prepayment. And I think they certainly had the discretion to treat that interest income as good real estate income. And even going further, that you could look and just say that the loan is really secured by the owner's real estate and therefore should be treated as good mortgage 75% income. So an interesting ruling, answers some questions, leaves over other questions, and has other possible interpretations that they could have reached but didn't.